All right. We are live Monday, 6 p.m. Pacific Standard Time. As always, here to answer your questions live and direct. And I got to tell you, I've had a really good day. I've had a fun-filled day filled with talking to real estate agents, talking to clients, really just been on the phone all day long. And sometimes it'll wear you down. Sometimes it'll energize you. When you talk to a bunch of awesome people, you get offers accepted, you're doing things. It can be an exciting time. So I'm excited. I'm pumped up. I'm ready to answer folks' questions. I'm ready to get real and give you some real honest feedback. What I did today, I answer most calls I get that are in California if I'm not on another call. And I answered a call. It was a robocall, like a refinance deal. And it was very interesting because the guy obviously is in a big call center and he's calling to just chum up refinance because a lot of these places have too many employees. And so they're, trying to do something, I guess, to stir up business, even in cases where it doesn't make sense, right? And so they call me, hey, you've got a mortgage. What's your mortgage interest rate? And I know what path they're trying to lead me down. I just want to hear the questions they're asking. So I actually recorded it. I might put out some content later this week. Some of this recorded live call from what these call centers are telling people, because I want to know. I want to know what they're telling my clients. I want to know what they're saying. Where'd I put the notes? Long story short, I asked him about interest rates in the last 6 months, and he says they're down, which is a lie. I also asked him if I can get a 2% on a 30-year fixed. He said yes. Basically told me whatever I wanted to hear, as long as I would take a few steps in the direction towards talking to loan professional, talking to whoever he was going to refer me to try to talk me into doing a deal, even if it didn't make sense to me, right? Which grinds my gears like no other. That's why I'm on here live every Monday, trying to give people good, honest feedback on mortgage versus all the garbage that's on the internet. So, I'm here to save folks. If you're wondering, we're painting the office soon. Those are the colors. My wifey, let's see, let's call this number 5, number 4, number 3, number 2, number 1. We'll do a thing later on when we've got like 40 or 50 people join. We're not going to vote yet. Later we'll vote on what color. And my wife's already decided. So you guys have no say, just like me. But it'll be fun nonetheless. So Jermaine Battles from San Antonio, Texas. Thanks for joining. Appreciate you being on, my man. Janice Williams from Cape Cod, Massachusetts. Thank you for jumping on. Any questions you guys have, I'm happy to help. Nairan, down the street from me in Folsom, buying a new build. Are there jumbo loan products that will let me close the loan for the new home with 10% down initially and then allow a mortgage recast after selling my old home? 100% yes. A lot of lenders do this, and I would say most lenders that I broker to will allow you to do this. And anybody who doesn't know what a recast is, on my channel, if you search recast Matt the Mortgage Guy, you'll be able to find it. What happens is, let's say, just total example here for Nairan, that he's buying something for $1 million in Folsom, which is a very popular place to be. $1 million is probably a nice home though. 10% down. So he's got a $900,000 loan amount. That will be a jumbo loan in Sacramento County. And he's planning on selling a house. He's going to have $300,000 in equity from that, which he wants to place on his new house. So what'll happen, Nairan, is you'll close. You'll take that $300,000, put it as a big lump sum towards the new loan, which is $900,000. They'll allow you to recast it, and you'll only owe $600,000. So there's some nuance to it, and there's some rules about how you do it and how long it takes and all that. Happy to get to that with you, but ping me if you'd like, or ping my team. Go to greatmortgagebroker.com, fill out that 6 quick form, and we'll talk to you. Sounds like you got some time because you're waiting on a new build in Folsom, so we can talk through like what the loan's going to look like short term, what it's going to look like if you recast it. So what you might want to do is, even better than recasting. Take a high rate on the jumbo, close it with maybe some credits, and then refinance in 6 months. I guess you're gambling that the market's not going to change that much, but on that 625 conforming limit, which might even be even higher in 2022, you're going to be able to considerably better rate than you would on the jumbo with 10% down. So you probably want to do it that way. You probably want to close it and then refinance it versus the recast, because the recast, the rate stays the same. So yeah, now that I think about it and talk it through, that's definitely the play. The play is close it, knowing that you're going to refinance it after you sell and can apply all that principal towards the new home. Close it jumbo, take maybe the highest rate possible that might include enough rebate to pay all your closing costs. 6 months later, throw the new principal, do like a cash in refinance, bring it down to 625. I got you, Nyran. That's the plan. That's the plan for sure. Quantrell Smith, thanks for joining. What are your thoughts on quick move-in new construction homes? Well, some people like new homes. Some people like new cars. That one's probably personal preference. And quick move-in, I don't know if that's like a special program or like if that's just what you call the stuff that's already built and done. But yeah, I mean, I'm a big believer in real estate. I'm bullish on real estate now, next year, last year, 5 years from now, 10 years from now. And so, just like resale homes, new construction homes are a great long-term investment. It just depends on what you're looking for, right? And, some people really want an established neighborhood. Other people want, a new build. And I guess, it's hard to tell. I remember it's hard to like answer that question for somebody else, right? I'm perfectly happy in my resale home. The next home I buy will probably be resale. It won't be new construction. The only downside to new construction, in my opinion, at least for my local area, California, is the lots are just, in general, fairly small. Is there any roommate income programs? Is there a max income for those lower income areas only? It's a great question, Nicole. And what I think you're referring to is boarder income, which they call roommates boarders, BOARDERS. I think that's how you spell it. Though you can only use that if you have that prior, right? You can only use boarder income if you've shown history of having it in the past, which almost nobody does, right? Like I don't file my tax returns and be like, oh, I had roommates for 12 months. Very rare, right? So it's hard to use that income. Emily Flynn, thanks for joining. Go ahead and ask all the questions you want, because what I've learned through doing lots of these is there's a good mix. There's a good mix of real estate agents, consumers that are looking to buy, and new real estate agents. I got off a couple phone calls today with brokers from around the country. I'm happy to help answer questions about, loan stuff in general for consumers, real estate agents, and new loan officers alike. So ask away. I appreciate the support. Appreciate you following. Whatever I can do to add value, I'd love to. That's the name of the game as a loan officer. You add value to as many people as possible. You let the rest take care of itself. The fulfillment of the loans, you get good support staff to handle that. All the other stuff takes care of itself as long as you add enough value. So do that. Let me see. If there's not any other questions, I was going to try to pull up this article. Talk about Zillow buying homes. People are always worried about what Zillow's doing. They want to know what Zillow's doing. And I'm telling you, you guys think that like iBuyers did a lot this year. We're like, oh man, I'm seeing more and more iBuyers buy stuff. Like they're coming. they're just not coming in like they're taking over the market kind of way that some TikTokers will lead you to believe. But they're definitely, going to take up more and more market share. And it might be 3, 4, 5% of the market that, iBuyers take control of. Either, somebody's moving and views it as a less painful and stressful process by just using an iBuyer, or whatever the circumstances. A certain percentage of the demographic is going to choose that versus, the normal real estate process and real estate agent. But real estate agent partners, please hear me when I tell you, like, they're not taking over, right? If 95% of the business is still done by agents, you're in good shape, right? If 5% of loans are done through automated services and automation, I'm fine with that. 10% are done, I'm fine with that. I've still got 90% of the pie to go after, and to serve folks that prefer to have the human element involved, prefer to have a high-level advisor working on their side, on their behalf, to walk them through what is the largest financial transaction for most people, right? Buying a home, financing a home, refinancing a home. It's a big deal to a lot of people. So I don't expect any robot to take my job anytime soon. I'm going to be just fine. All right. What questions do folks have? Let's talk. Do we want to talk about the paint colors yet? Which way are we going to go? 1, 2, 3, 4, 5. We got to vote. Which one do you like? Paint color number 1, number 2, number 3, number 4, or number 5. Vote for a paint color. Smash the like button. Let me know. We're painting that wall. Next Monday. You like the WR, Emily? I don't know what these things stand for. Miss Taylor, number 2. It's kind of hard to see in this, I think. Naruto Brown, number 5. All right. So far, we've got 3 votes and 3 different ones. Number 1 is this side. 1, 2, 3, 4, 5. All right. I'll let you guys know later what the wife decided, and it's going to be painted this week, I think. I think this week is the plan. Paint that wall. We're starting to put this office together. Over there, some baseball stuff. Coaching the kiddos baseball. Paint that wall as well. We've got some more stuff to put together, but we're in the Sacramento office. We are excited to be landed, doing a grand opening next week. All right. Number 5. Keep it white? Could keep it white. Actually, you kind of look nice white, huh? I don't know. Something about an accent wall. Wife? Let's be honest, guys. I don't get any say in this. My wife wants an accent wall in the office. We're putting a friggin' accent wall in the office. Kraler May, great to see you, man. I appreciate the super chat. You are a scholar and a gentleman. I appreciate the super chat. Let's see. What credit score do you need to qualify for a decent rate? They have a 700 on Credit Karma. So probably a 680 when pulled. I mean, the credit score is a piece of it, but also how much down payment. Because 700 or 680 with 3% down might look a little gnarly, and gnarly is, relative because rates are still super low, versus 5%, 10%, 20%, 30%. Because really, like, you put 40% down, you can have a 680 or 760. It's not that much difference because 40% down is making the lender feel good about themselves. So the smaller down payment, the more that credit score is going to impact it. But if you have a 680 versus 740, I'm going to do it for you real quick, because I want to see it. And I'll tell you the difference. I talked to somebody today. Do people not know that rates have gone up? Rates have gone up like 0.3% since early August. Oh, they're doing at least 35% down. That's good. So in that case, it's gonna be a good looking loan, kind of regardless, right? I'm gonna put in. I'm gonna put in 680 score and 35% down. And I bet you at 680, it's still pretty good looking. Pretty good looking. All right, 680. You can still do about a 3.1. A 3.1 with no points. Now, if you had a 760, you had nice credit, it's not that much different. Bear with the pricer while the pricer does its work. Yeah, I mean, now you've got a couple grand in credit at that 3.1, but not much different. I mean, still going to pay a little bit for 3%. So, yeah, 35% down. Good news, Kraler. 680, 720, 760, all good. 3.1-ish percent is what they're going to be looking at. And really, I don't know how big of a loan amount it is. But remember, the smaller loan amounts, the lenders build in more margin because they don't want the small loan amounts. So if it's a $200,000 loan, not necessarily going to be as good, maybe 3.25. If it's a $500,000 loan, maybe it's 3% because that's how lenders roll. Bigger the loan, thinner the margin, better rate. All right. I got you, man. I appreciate you. Glad it was helpful. All right. Red Sunset 101 wants to know, how long after closing can I refinance out of a first and a second into one loan? Does the increase in conforming loan limits next year help me when I refinance? For sure. And a lot of lenders that I broker to, are already honoring those newer loan limits. So like 625,000 we can do with most lenders, depending on what part of the country you're in. If you're in a high balance county, some of those high balance limits are going to be like 937,500 is the word on the streets. You know, counties like Los Angeles, San Francisco County, the high balance, high cost counties, be able to do a conforming loan up to 937. Across the board, the new conforming limit across the country is going to be like 625,000 plus. So, yes, those help you when you refinance because you can refinance higher and get the conforming loan rates, which are better. Santa Barbara County, yeah, for sure. So Santa Barbara is going to be 937-ish. And so what's going to happen is up to 625, you're conforming conventional. Up to 937, you're high balance conforming. So you can, those two buckets, and then above 937 is jumbo. If you fall between that 625 and the 937, just slightly higher interest rate. And so, yeah, the refinancing of the first and second, I don't know if did you do like an 80-10-10 or something where you put like 10% down, 10% second, 80% first? You want to combine those two or something? Whatever the case, sure. Rates or conforming limits go up, helps you refinance and combine those two loans. Just keep in mind, you want to combine those and still be under 80% loan to value. If it was like an 80-10-10 deal. This is a good question right here. Kyle, really good question. Tons of people are buying new builds. Tons of people are getting on lists that are, getting longer and longer for new build stuff. So if you get into a new build where it's 12 months until it's done. And right now you're approved. You've got a 3.125 interest rate. Your DTI is 44.37, and you put down a 10% deposit. First of all, it's a hefty freaking deposit. I talked to a guy today who might back out of a new build, and he got $5,000 is his deposit on like a $655,000 deal. Builder probably doesn't give a shit if he backs out, because the builder can probably sell it for $720 now. But anyhow, I digress. You could be in a position where you wouldn't qualify anymore. And honestly, Fannie and Freddie, where these loans are being delivered, they don't care if you've been 12 months waiting for this thing. So with all that being said, you're going to want to, one, have a little bit of buffer, right? Where you're not that close. And it's like, I barely qualify for this now. If rates go up a quarter, I can't qualify for it. Get into a house where you've got enough wiggle room, where if rates go up a quarter or 3/4, you're still going to be able to buy the house. And with that being said, rates might go up a quarter or 3/8 in the next 5 or 6 months. Then maybe you want to say, I'm going to bite the bullet and do a 180-day lock and lock it 6 months out, just because the alternative's bad, right? The alternative where you don't qualify anymore and you're donezo. That's my 2 cents. All right, Red Sunset, since you're in Santa Barbara, you need to hit us up. We'll take a look at those first and second, see what it's going to look like to do a. If they're both purchase money, if the first and second both were used to purchase, you can do a refinance. We can call it a rate and term refinance. We get the same pricing as a rate and term versus a cash out. If you buy a house 3 years later, get a home equity line of credit, 2 years after that, go do a refinance, try to combine those two loans, pay them both off, it's considered a cash out. But if you got a first and a second, they're both considered purchase money, you can refinance and consider it a rate and term. Charles Ho, thanks for joining. If the current investment property has no existing loan, can you deduct the mortgage interest from a cash out refinance on this investment property? I am going to defer to your CPA. I do not want to answer tax questions because no good can come out of it. Methinks you're going to deduct that mortgage interest just as you would, having the loan now, having the loan then. That is me inclination, but I shall not answer. I shall defer to a certified public accountant. Quantrell, it's a great question. How do you know if you're in a high balance area? If you go and you look up Santa Barbara County loan limits, this is where my friend Google is going to hook me up. You'll see, fairly close to the top. And I guess this one too, like you can go to loanlimits.org. Let's see if this has anything good on it. Oh, check this out. This doesn't have the updated stuff, but I Googled. Let me see if I can put this on here. Let's see if I can share my screen. I just Googled Santa Barbara loan limits. And this page popped up and I could scroll down. Or I'm sorry. Yeah, then I found loanlimits.org. And this is California. I think you can probably do whatever state you wanted. It'll tell you the loan limits in the different counties. And you can see Marin, high balance county up to 822. Napa, 816. Monterey, 739. San Benito, 822. Like I said, these ones that say 548, 250, lenders are already saying okay to 625, which is going to be this new conforming limit come next year. You see 4 rows across here in case you missed it. There's different limits for different numbers of units: 1 unit, 2 unit, 3 unit, 4 unit. So you could do it like this, or you could even say conventional loan limit. See if you do, well, see if I say in California, you'll have to scroll through some crap. Quicken's paying for a lot of stuff. You got to pay for that somehow. If you want to help Quicken pay for all this advertising, go get one of their mortgages that come with like 2 points being charged. That's how you can help them pay for advertising. I don't know. I would just use Google and look up your county, and you'll be able to find it on there. So make sure you look up, conventional for that, and then you'll be able to find it. I got faith in you. Google is a powerful thing. All right, stop share. There we go. Great question here by Megan. Do you expect rates to go back down? I've never been like sure one this way or sure this way. I'm always like, who really knows? I'm telling you right now, no, rates are not going back down. Like I'm usually fairly center of the road. Like it could go down, they could go up. Who knows? Like I was surprised before. I could be surprised again. I'm fairly confident, like 99% rates are going up. I mean, the Fed late September said, hey, November, we're going to start tapering back our purchase of mortgage-backed securities. What that is going to do is going to allow rates to start to rise, because without all their purchase of mortgage-backed securities, without the Fed like pushing rates down by being like, we're throwing money at this, we're buying mortgage-backed securities, rates would be higher. Without Fed intervention, rates would be 4.5% right now. And so as they let their foot off the gas with the purchase of mortgage-backed securities, rates will go up, no doubt. They're not going to go to 6%, so nobody get too worried. But they've already gone up like 0.3% in the last 60 days. Early August to now, mid-October, these last 8 to 10 weeks have been not so good for mortgage rates. You can have people that lie to you all you want. I'm going to tell you the truth. They've gone up. They've gone up about 3/8. So stuff that was pricing at 2.75 is now pricing at 3.125. If stuff was pricing at 2.99, it's now pricing at 3.375. And it's all different, right? It's all based on your down payment, based on your credit score, all those different criteria. But across the board, you can expect it to be about 3/8 worse. Don't shoot the messenger. I'm just telling you what's going on. Naruto, thanks for joining. I recently did a cash out refinance. I owe about $400. Once my ADU is built, my property will be worth $850. Would I be able to do another cash out refinance? Sweet. The answer is yes. Here's the caveat. Being in California, I know about ADUs. And working with investors, I've done numerous deals where we had an ADU or sometimes two in the back of a property. And so you've got to make sure that the lender is going to view it as a single family residence plus ADU, or you're going to be, having to go by the guidelines that might be slightly different if it's considered a duplex. And I'll give you an example. If you have a 1,200 square foot house and you have a 1,200 square foot ADU that was built, an appraiser is probably going to come out and appraise that thing and just call it a second unit, which is fine. You can still do a cash out refinance of a 2 unit. It's just going to be capped at 70% loan to value versus 75. Pricing is going to be slightly different because 2-unit versus single family pricing is a little bit worse. So just all that stuff considered, it's going to be different, but it's certainly possible. And yeah, you'd be able to pull a couple hundred out on that one. What's 850 times 75%? If it was a single family, you could do a loan up to 637, which if it's a single family, you're going to want to keep that at 625 because we talked about that loan limit, 625. If it's a duplex and they consider it a duplex, then you're capped at 70%. Then you're like 595 loan amount. So almost 200 out. Oh, dang, Jermaine. Credit union came back and made you pay back the lender credit they paid because I paid off the loan early. Yeah, if you pay off within 6 months, it can be an early payoff. And usually that's hit by the loan officer. Whoever writes the loan usually writes that check. But they came back to you? That's pretty gangster. That's gangster credit union right there. Pay us back. We gave you this lender credit. You paid off the loan early. I don't know. Maybe it was written in there. Some sort of prepay penalty. Arnold, congratulations. Closed on your first house this afternoon. That's awesome news. Congrats. That's good to hear. I love hearing success stories. Mass housing program closes in 30 days. Yeah, let us know. Was it some sort of like down payment assistance or some sort of, when I think mass housing, I'm thinking Massachusetts. Am I wrong? Is it Massachusetts housing program? All right, Zeta. Your tablet was buffering. You missed it. We gave away tomorrow's winning lotto numbers. No, you didn't miss much. Just us chatting. Oh, you know what you missed, Zeta? 1, 2, 3, 4, 5. You're the final vote, Zeta. Whatever you vote, we're going to paint it. And next Monday, you're going to see the new and improved wall color. 1, 2, 3, 4, 5. Zeta Willingham is here. She supports the channel. She comments on my videos. She gets the final say. Let us know, Zeta. All right, Kyle. So the builder raised the deposit from 5% to 10% in the last few months since they're selling like hotcakes. I guess that kind of makes sense, right? It's like they want people. I mean, they got you by the huevos rancheros when you got 10% in there. You'd have to read the contract to know if you'd lose that 10% deposit, because on a regular resale home, you're going to have a loan contingency. And if something goes wrong with your loan, you can back out and receive your deposit back. But I don't know if they're going to let you keep a loan contingency for 12 months. But definitely ask them. Hey, Reagan, the problem with this is you said my bank. And banks are like dinosaurs. They had their place on this earth at one time. But when you're talking about getting a home loan, a mortgage loan, you go into a bank and they got to dust off that dusty old desk. Really, they just, you put a mortgage broker and a bank side by side in a mortgage transaction, it's like me running a foot race against an 18-month-old. I'm going to win every time. And so yeah, some banks are just tightening what kind of business they want or they service. Some big banks just said, we don't want rental properties at all. You can definitely do a cash out refinance on a rental property. And, so banks will do only a certain credit score and higher, no investment properties. Yeah, ditch the bank. When you're getting a loan, you know what? This is a great time to plug tonight's sponsor. Not really a sponsor. GreatMortgageBroker.com. If your bank doesn't do investment properties, if your bank is operating a business like it's 1987, GreatMortgageBroker.com. Connect with me and my team, whether you're in Florida, whether you're in Tennessee, whether you're in Oregon, Utah, Ohio, Arizona. Give us a ring. We'll help you out. It's 6 quick questions, and you won't be stuck with a bank who doesn't do investment properties. Corey, have you ever experienced trouble pushing a loan through for a new construction condo that didn't have enough comps during the appraisal process? Most lenders want you to have a certain number of closed units before they'll lend on a specific project till it's like quote unquote warrantable. But I haven't had that specific problem, Corey, and I would guess that you'd have to have. We had the appraiser on last week, Ryan Lundquist, best appraiser in the world, and trying to step into his shoes and his brain and answer this on his behalf. If you don't have enough comparables in that condo complex as an appraiser, you're going to have to find like-kind properties. There has to be some condo project somewhere that you can find comparables that have sold, right? Maybe it's not in that specific complex. Maybe it's not within a half-mile radius, but 3 miles away, similar neighborhood, similar demographics, similar home prices. They've had condos sell, and you can use those as comps. That's just my guess and my 2 cents. Ooh. Thoughts on an extended rate lock till July? Adds 0.375 30-day float down. Where they start? Where's their baseline, Aaron? Like 3%? So they'll give you like a 3.375 until July? That's what I'd be curious about, because if the 0.375 is on top of 3.5, and they're 3.875, that's gnarly. But if they're saying, oh yeah, 3% is our par rate today, 3.375, we'll lock it till July, I probably would, right? Because then it's like set it and forget it. July is a long ways away. Long. It's like 9 months, right? So for sure, I'd probably take it. Kevin Hawthorne, salud. How you doing, my man? Hope everything's well in Florida. Hope you're doing well. Keep up the good work. All right, Jason Hibbert. Refinance FHA last December. If I cash out my FHA to conventional, do I still have to live in the property for a year? This is a great question. I'm getting this question more and more. It's like, if I refinance, does that restart this 12-month thing? And I think what I'm getting is honest investors who are like, hey, listen, I'm going to refinance this property, but I'm looking to do some investing. This is going to turn into an investment property for me. I don't know if that's 6 months out or a year out, but that's the plan. Here's my honest advice is you intend to live there for a year when you refinance it as your primary residence. If come July of next year, you find an amazing primary and you turn this one into a rental, the lender might ask you, hey, you just refinanced. Why the move? There's tons of legitimate reasons. Like, this house came up. It's in the neighborhood I want to send my kids to school in. It works for us as a primary. We're moving. End of story, right? Where people get tripped up is like, you can't refinance this in like November of 2021 and then try to buy a new primary in January. That's like loan fraud. It's pretty clear that this isn't your primary. I know people like currently in contract trying to buy a new primary in that scenario where it's like right after the other. Lender says, go refinance the one you're leaving as an investment property, or we can't close on this purchase. And then you're stuck, right? That's gnarly. But if you do it now, 6 months, 9 months, 12 months down the road, things change and you buy a new primary, I don't think that you're, doing anything fraudulent. You intended to stay there a year. things might have progressed quicker than you thought, and now you're buying a new primary 9 months down the road. Hopefully that answered your question, Jason. I don't know, Corey. I think the only people that really talk about more and more non-QM loans are the non-QM account executives. Oh man. With that being said, those loans have a place, right? And there's a place for those loans. And so maybe next year or in preceding years, as we got more people that are self-employed, more people that can't qualify for the conventional stuff, the non-QM stuff starts to pick up some speed, and more of those loans are written. So it's possible. I don't see it doubling in the next year, but I could see it increasing by 50%. So sure, they'll continue to increase. By how much, who knows? All right, Jorge G. Realty. Hopefully you're a real estate agent. Thanks for joining. If list price is $400 now for $430, I am willing to go $15K over appraisal if it comes in low. Let's say it comes in at $410. Do I pay closing costs on $410 or $425? Okay, so you offer $430, and then you say I'm willing to pay up to $15,000 over the appraised value, not to exceed $430,000. That's how the offer is written. The appraisal comes in at $410,000. Since you wrote it into the contract, you're willing to pay $15 over. Your purchase price is $425. Sale price $425. Property taxes, everything based on $425. And I guess what you're asking is closing costs. Like the property tax and everything is based off of sale price. So $425 is that sale price. And that's the only thing, like the lender, most of the costs aren't necessarily tied to the price, is what I'm trying to say. But $425, yes, is what you'd pay. Like everything's based off of that number, because you're going to pay $425 for the property. Yeah, I think that's all there is to be said about that one. Let me know if that was clear, if I got to clear that up. I don't know. All right, Lucerne. Does the bank use front-end loading or back-end loading to calculate the DTI? What the heck is front-end loading? You're gonna have to do that. Michelle, appreciate the kind words. I really do. I do have a great team, and I can't take the credit. I just got to give all the credit to them. So let me snap a picture for them, Michelle, so I can pass the information on, because I've got a team that works tirelessly. I appreciate them. They appreciate you and the kind words. So let's commemorate this moment. Thanks for those kind words. I appreciate it, Michelle. Arpit Mahindru. What's the best way to negotiate rates with one's local lender? I think that this is a really tricky and slippery slope, because I've said this in past videos, and I believe it now more than ever. I literally had somebody go into contract over the weekend, send me something and say, hey, can you beat this? This person's offering this. I look at this loan estimate. There's no homeowner's insurance being prepaid, which has to be done. The number of months of property taxes is not enough. And he's like, look, I only need $33,000 cash to close with them. Can you do this? Well, not only can I not do it, but they can't do it. They're lying to get the business, and they're misinterpreting or undercutting what needs to be held back, property taxes and homeowners insurance reserves. And so it's sad, right? Because most people are like, oh, they promised me this. Like, they're probably good for it. proceed with them. 3 weeks from now, that person who was like, I got the person who's able to do it for 33,000 cash to close for me. In 3 weeks, they're going to come back and they're going to have one of many excuses I've heard. Oh, you know what? We just got word back from the county. We've got to collect 7 months worth of reserves on your. We know that. We all know that, like right now, right? Oh, yeah, like this is a third party cost. This isn't us, but we have to collect the $1,300 for the homeowner's insurance and 3 months of reserves. Sorry about that. There's $5,000 in costs that weren't accounted for in here. Me telling the client that just feels to them like Matt's just saying that, right? The joke's on them. And so like, be careful what you wish for, I guess is my warning to you. This online lender that called me today and I talked to him and just wanted to hear how they talk to people so I could know how they talk to clients, basically told me yes to anything I asked. And so the harder you look for the best rates, the more likely you are to find the biggest liar. You're going to find the biggest liar who's going to have you miss out on a home, have you fall out of contract, and really like leave you a sour taste when they put together a stellar looking loan estimate where you're like, wow, they're better. They're better than Matt and his team by $2,500. Then a week before you're going to close, you're already too far into it. You paid for appraisal, you paid for inspections, your whatever. Their stuff goes up $3,000, and now you're $500 worse than the person who was honest in the beginning. And so, yeah, it's kind of a warning. Find a local mortgage broker you like and trust. Know that a broker like me is going to be very competitive when it comes to rates and fees. Better than banks, better than retail lenders, within a few $100s of some of the thinnest margin online shitholes that operate as banks, and half of them go out of business, half of them survive. I don't know if it's something you want to gamble with, right? That might have been a long-winded answer, but the moral of the story is cheapest isn't always best, and cheapest sometimes isn't even cheapest. Because I've seen it too, where like there's a lot of smoke and mirrors, and I'm like, we're better than that. When you factor in that fee, and that fee, and they've got a 2.875, but their mortgage insurance is 170. We're 2.92, and our mortgage insurance is 104. We're better by $38 a month, and we got $1,000 less in fees. Average person looking at that, it's just like 2.875 sounded like better than 2.92. So I'd probably go with that one. Yeah. Talk to someone you like and trust. Let them put the stuff side by side and do apples to apples. The end. Zeta, number 1. Sorry, my wife already chose number 5. If 1, 2, 3, 4, 5. Yeah, number 5. If this was number 1, maybe you're looking at it the wrong way. Sorry, Zeta. I told you had control, but really my wife's the boss. Quantrell, does the builder's lender generally have overlays? It depends, because the builder's lender is just whoever they decide to have as their partnered in-house lender. If their partner's in-house lender is Chase, they've got overlays galore, right? And only doing perfect paper. If their in-house lender is, a local broker, then maybe they've got some more lax guidelines, a little bit more flexible. So I guess it depends. That's my answer. Looking to get a new construction loan or a construction loan, like ground up construction. Umpqua Bank does really good construction loans in California. I don't broker those out because I'm not the master of construction loans. So I don't know who the best construction folks are in Texas, Jermaine, but all right. Megan's talking about new construction in Chicago. Yeah, they tend to increase prices as more homes are sold. Yeah, this is pretty common in a lot of places. And I think, you know, in a market like we're in, where home prices appreciate, you can do that and they'll continue to appraise because, like Ryan said last week when he was on here, Ryan Lundquist, SacramentoAppraisalBlog.com, you can take that into account. Stuff here sold for 510, 520, 530. So if we appraise this thing at 540, we're not that far off base. We can show, you know, the direction of the market, I guess is one way to put it. Thank you, Michelle. The team is the best. Loans where the only look at 1099s and not tax returns are non-QM loans, correct? I mean, not necessarily. Non-QM is a type of loan where they're not looking at the standard debt to income ratio rules and things like that. There are, you know, different types of non-QM loans in that bucket. There's bank statement loans where they take a look at your last 12 or last 24 bank statements. They, you know, divide that by number of months, maybe take a 50% expense ratio and then say, okay, there's 8,000 a month that we can use in income, and they'll underwrite you that way. Or there's like debt service coverage ratio loans where whatever the debt payment is, principal, interest, tax, and insurance versus what the thing would rent for, that's how they're going to qualify whether they can do a loan or not. And so, you know, non-QM is basically like non-traditional, you know, conventional FHA type of loan, right? And so there's a lot of different products out there that fall underneath that bucket. All right, Lucerne, what are we talking over here? We're talking about what is the front end debt to income ratio. The front end debt to income ratio is a variation of the DTI that calculates how much of a person's gross income is going to. Okay. So let me go back to your original question, because I know you were asking about, where'd it go now? You're asking whether they look at front end or back end. Oh, okay. Does the bank use the front or the back to calculate the DTI? They use both. So when you see that, like you pulled up the definitions for front end debt to income ratio and back end debt to income ratio. For anybody that doesn't know, you make $10,000 a month. You have a $2,000 mortgage payment. That's a 20% front end ratio. The front end ratio is just your housing expense only. You've got a $500 student loan payment and a $500 car payment and $200 in credit card payments. You add those, $1,200 to the equation. Now you've got the $2,000 mortgage, 5, 5, and 2. So you got $3,200 total versus your $10,000 income, 32% back end. So they'd call that 20% $2,000 mortgage payment the front end, 20 over 32. That's how the lender looks at it. 20 over 32 is going to get you an approved eligible most of the time with good credit. And the answer to your question, Lucerne, is they look at both. If you start getting up where you're 39 over 44, that's where it's like, yeah, you got good credit. Yeah, you've got reserves. Probably getting approved eligible. Not good credit, no reserves, you might be in trouble. And it depends on program too. If it's FHA, you might be able to get away with 43 over 49. It's conventional. That front end's probably got to be below 40 and the back end's probably got to be below 45. So that's that. Let me know if that answers the question for you. But, you know, the original question, which one they look at? Both for sure. Harminder. I hope we can beat a credit union too. We should be able to. And we'll close it quicker. And it'll be a smoother process. And I'll call the list side and help get your offer accepted. A lot of reasons to work with the Math Mortgage Guy team, Harminder. I don't want to list them all here. I don't want to, beat our drum too much, but All right, Megan, new subscriber. Tell your friends to join too. Yeah, Zeta, listen to my wife. I get to keep coming back every Monday as long as I'm listening. Sarah Lynn, thanks for joining. We are recently buying a house without a realtor. It's for sale by owner. Offer accepted. Anything we should be aware of? No, the key in this situation is make sure you have a really good lender. Your follow-up question was when to buy home insurance. You're going to do that during the buying process, during the mortgage process. And so probably a 30-day contract is what my guess is. Lender is going to get together the paperwork. They're going to have you look at some quotes from their preferred homeowners insurance folks, or they're going to, maybe tell you, talk to whoever you have your auto insurance through, whether that's, State Farm or Farmers, but that'll be during the process because the lender is going to make sure they're going to require that you have that in place before you close the loan. That first year of homeowners insurance premium is going to be paid through escrow. So do that. I don't know if you're in California, but hit us up if you need any help with that, because we did a ton of those in 2020. With the market being as competitive as it was, I found people getting more and more creative with how they were buying houses. Talk to the owner of the place they're renting. Hey, can we put a deal together? I'll pay you $550 for this. Sounds fair to me. Okay, write up a contract, connect with your lender. We do the loan, bada bing, bada boom, we're done. So we did probably, a dozen of those last year where it was, directly between the seller and the buyer, no real estate agent, which, can be a little bit dangerous, proceed with caution. But some deals get put together like that. Sorry for my realtor friends. That happens sometimes. My man, Dorian, Black Box Mobile Fitness. Thanks for joining, man. Appreciate you being here. Appreciate your friendship, brother. Hope keep doing good work, man. The Riley Oak. My wife and I want to upgrade our home and turn our current home into a rental. Can we use that potential income to help our debt to income ratio? We have not had renters yet, though. Yes, you can use it as rental income. It's basically like departing rental income. And you used to need like the deposit. Now, most lenders just want you to have a lease agreement. So as you're preparing to leave, buy the new house, rent out this old one, find some renters, have them sign a lease starting December 1st. They're paying $2,100 a month. We can use 75% of that as rental income. And because I used a number that wasn't round, like 21, 75% of that is $1,575. Mondays are always late, so I sometimes have to use a calculator. Yeah, $1,575. Why did I ever doubt myself? $1,575 on the income side. You can use it as rental income. So you make $10,000 a month. You add the $1,575, so now you got $11,575. Current mortgage, new mortgage, all debts, all go on the debt side. $11,575 versus both mortgages and debts is how your debt to income ratio is going to be calculated. Where do you see rates in December? It's pretty close. It's only 6 weeks away. They're hovering near 3% right now. If I were to guess, they're up an eighth in December in 6 weeks. Pretty flat with a slight skew towards the upside. Final answer. Why do I see my lender only considering rental incomes for some properties but not others? And they don't use full rental values, only part of it, even though I send the signed lease. If you've owned these rentals for years and they hit your tax return, your Schedule E, Schedule of Real Estate Owned, is where they're going to take the numbers from. And they're going to, put into that Schedule E or into the rental income calculator all those numbers. Rental income calculator. Let me see if I got a blank one around here. All right, I had to take out the borrower's name. Let me see if zoom in. All right. This is what your Schedule E is going to have. Total rents received, total expenses. Man, this is hard to read. Insurance, mortgage interest, tax, depreciation. So basically you take like rents received, you minus out expenses, and you get to add back insurance, mortgage interest, and taxes. And depreciation you can add back. Then you're going to get the come on. Adjusted rental income. Divide that puppy, right? By 12. And that's where you get, sometimes you're going to have a loss, right? Like a 621 loss. So if it's been on your tax return the last couple of years, we're going to use that. Yeah. So there you go. Know thyself. That's probably my guess on why they're not, you're like, hey, this thing's renting for $2,000 a month. Why are they not giving me any rental income? If it's showing as a loss in your tax returns, then that is probably the reason. Harminder, I think so. I think I enjoy having guests on. I think I got to figure out who to have on, who not to have on. I've had some interesting ideas, like an underwriter. If I had an underwriter come on here and answer questions, I can certainly get an underwriter to come join me. I got a buddy who works in like housing policy, and specifically around like housing policy and how to improve housing policy so that minority groups home ownership rates can increase and get in line with that of the home ownership rates of some of the folks that own the most property in the United States. So I think so. I would enjoy it. Part of me enjoys the Q&A where it's just me, where I can just rattle through and answer every single person's question every time. I think there's some value in that, but also it's cool for me to have guests on. I learn stuff. And so, shoot me whoever you want to see. And maybe it's somebody that, I collaborate with, or maybe it's somebody that could get on here and can just answer questions. Real estate agents who have kind of a feel for the market in different areas is always fun. Sometimes, sorry, got sidetracked there. Lucerne. Do you see any issues with the future mortgage interest rates in USA? Evergrande crisis. I don't think it's going to have that big of a ripple effect on the US. Anybody who follows international economic news, Evergrande is China's biggest real estate developer, or one of the two biggest real estate developers, and they're going to go belly up. Most likely they got billions on billions in debt that they're starting to default on. The Chinese housing market is in a lot of trouble. Whether or not that has any sort of ripple effect on the U.S. economy or the U.S. housing market is yet to be seen. But I think it's going to be fairly contained to China and not really affect us, is my gut feeling. Know thyself first. I'm pretty excited about too, man. All 50 states. Do you only do GSE loans? I mean, as a broker, I've got the ability to broker to pretty much uh, any of the wholesale lenders. But I think what you're asking is like, you know, some lenders are doing their own securities for second homes or investment property loans. Are you talking about some sort of like portfolio loans? If so, not really doing that stuff, to be honest. Like there's different lenders that have different overlays and different pricing structures for investment loans. And so the investors I work with, like we're doing, the Fannie Freddie up to 10 of those with conventional financing. Other stuff that's a little bit more nichey, I probably am not going to be doing a lot of that, especially the next 3 or 6 months as we get settled and we're doing, 200 million in more vanilla type stuff, right? Because if we try to go too wide, we're going to lose our ability to provide high level customer service and really get refinances closed in 25 days, get people to finish on purchases in 21 days, and the high level service that I want to continue to provide. I can't do that if I'm doing, debt service coverage ratio loans, portfolio loans, all this stuff, right? Just not plausible unless I add and have a staff of 60, which we're just not, equipped to handle yet. Harminder, great question. What is UMortgage? UMortgage is a mortgage brokerage based in Philadelphia. In transition right now to UMortgage, I'm opening up a California branch. I'm adding licenses so that, Q4 of this year, we're going to be up to 43 states. By Q1 of next year, we should have all 50. And so exciting transition for me and my team, able to serve more people, have more help, more support to serve people at an even higher level. So the same level of support and education and guidance that you've expected from the Math and Mortgage Guy team will continue, and hopefully it's more, bigger, better, faster is the goal. So look up UMortgage if you'd like. The best answer to this, and I had a few buddies in a real estate investment group that I used to be part of that did this stuff, is go develop a relationship at usually a small bank with a commercial lender, because they have those blanket type loans where they say, okay, Mr. Know Thyself First, you've got $3 million in real estate over these, 20 loans. I don't know. Maybe that's a crazy number for California. It would be like 20 million. But maybe you got 20 loans in another state, right? Where the total debt is 3 million, total value is 5.5 million. They'll lend to you. I think most of those blanket loans are like 60% max loan to value, and the aggregate or the total of them, right, can't exceed 60% loan to value. But they'll give you a loan at 5% and just all one loan. That's really like your best bet. There's not a lot of stuff where like you're going to have people lining up to give you your 11th and 12th loan at 3.5%. It's just, you're going to have to pay a little bit of a premium. Good news is you can, package a bunch of them together. Oh, I like this. Underwriters and certified appraisers are least understood due to minimum accessibility. Let's welcome them on this in the future. I agree. Like a lot of folks are misunderstood. It would be good to have an underwriter on to be like, hey, why this? Why that? Explain it so people aren't just like, oh, underwriters are, just sitting back trying to press deny on a file and try to hold us back from getting home loans. It would be good. Who else is misunderstood who we can get on here? James Petrie. Do you get any better rates for putting 50% down? The sweet spot, James, is 40% down. 40% down is where lenders feel really good. The thing is, you're buying an investment property, between 20% and 25%, you're going to see a big jump. 20% down, rates are bad. 25% down, they get a lot better. 30 and then 40 might be slightly better and then slightly better than that. And so 25 is kind of the sweet spot, and then 40 is kind of where it maxes out, where if you put 40% down or 70% down, it's all the same. Truth be told, you're probably better with 40% down in your scenario, because 240 times 60%, then you're borrowing 144. If you borrow 120, a lot of lenders under 125 loan amount, you're going to get hit with an extra fee. The fee is, we don't want this small little loan. And so the way that lenders, without saying we don't want it, we're not going to take it, the way they adjust is like, okay, you want to send us your loan that's 120 grand? We're going to charge you a premium for it. And that might be, I've seen this before, that 120 with 50% down is a worse rate than 144 with 40% down, because the loan amount is smaller and it's worth less to them. Virginia is, hit me up, greatmortgagebroker.com. Happy to help. All right, we better put that up in case people forget about it. greatmortgagebroker.com. 6 quick questions. Get a reply within 24 hours. That's our, what do they call it? Like your promise? Standard operating procedure. Buyer has to wait for the seller to find a new home. How does this work? Buyer and seller close at the same date when seller finds a home. Maybe you bought a house and then you've got a seller who's got something written in where it's like contingent on them finding a replacement property. In that case, you kind of got to hang out. And then when they're like, all right, cool, we found one, we're going to close in 30 days. Then you plan your closing around that. Harminder, is lender services fee and origination fees the same? Yeah. What you want to do, I'm happy to help with this. And I think that you said you filled out something with us. The rate and the fees in box A is what you're looking at. You're going to find different quotes. And if you're a rate shopper, you're going to get yourself turned around, you're going to pick like something that may or may not be the best deal. But we generally structure our stuff with no fees in box A. Not going to be any fees. If you find something, you're like, hey, listen, Matt, why is this person 2.875 and you're 3.04? If they've got 3,900 in fees and I got 0, ours is better. I'm glad to charge you 3,900 in fees if you want, 2.82, then I'm better. But we're not structuring like that at the get-go because it just doesn't make sense for the consumer. If we lose deals because we do what's better for the consumer from the jump and it might not look as sexy, then so be it, right? We're still doing right by folks. What are the par rates for 25% down investment property loans in Texas? It depends on the loan size. Give me a loan size, I'll price it for you, and we'll take a look. We'll take a look at 25% down in Texas. Non-QM Home Express. Check out Home Express. They good. Yes, service level agreement. Thank you. Mondays are my long days. I should probably do this on a different day, but Mondays, I appreciate you having my back there. James Petrie, 2 loans at the same time. Yeah, I mean, you can negotiate. Well, they're 2 separate loans. So you can't necessarily say like, hey, I want to pay a smaller title fee here. Like title companies, like whatever. It's 2 different loans. So the answer is kind of no. If you're talking to a lender, I might be like, okay, I'll give you a break and I'll give you a $500 lender credit on each loan if we're doing 2 loans at the same time. All right, purchase price. What purchase price? Where people? There's properties out there that are 250 grand. Where are these properties? 75% loan to value. All right, I'm doing 265. Uh, 265, 75% loan to value, single family investment. Holy moly. What part of Texas you buy places for 250? 225. No fees at all. No origination, no processing, no lender fee, no nothing, like zero on box A. Then you're like 375. If you wanted to, pay 1,500 bucks in fees, you can go to 3.5. You want to pay $3,000 in fees, take it to 3.25. That give you an idea on this this little Texas deal you're talking about. 375, zero fees. 3.5, 1,500. 3.25, 3,000. Here's the thing: somebody might show you 3.5, and they've got 1055, 795, 1290. They've got all those fees. Like, I'm going to show you 375 and be like, there's nothing in box A, zero costs. But I mean, if it's a long-term hold, you might as well just throw 1,500 bucks at it, get it to 3.5, or even down to 3.25. I guess every quarter on that loan size is like 27 bucks a month. So you can decide. What's that? 1,500 divided by 27. 55-month break even. Yeah. It's not a clear either way. It's kind of an up to you type deal. All right, let's get into the last questions. I got a 7:30 phone call tonight talking to a buyer who's in contract, ready to roll. Culver City, California. You know what I got to do? Whoa. I got to update that to you, mortgage. Last call. Shutting the bar down. Last call for mortgage questions. I appreciate everyone joining. This is always good fun for me. Keeps me sharp. Keeps me on my toes. There wasn't any questions this week that I think I had to jot down because I didn't know the answer to. Last week we had Ryan on there. I left myself some notes. Basically, not everyone uses the tub because this isn't 1825. That's my best note from last week. This week, guests, who do we want to see? Who do we want to see? I'll let you guys who do we want to see? You guys let me know. I'll invite anybody. Thanks for joining, man. I appreciate you. Thanks for the support, man. This mortgage stuff is going to be fun. We are building a really, really, really cool company over at mortgage. Super cool culture, super cool people. You guys are going to see. All right, I'm out of here.